Thank you for joining. My name is Jason Selnow, and I am a partner with Oak Hill Business Partners here in the greater Milwaukee area. And we consult with growing businesses of all sizes, mostly in the Milwaukee area, but we're expanding into other markets. At Oak Hill Business Partners, we work with rapidly growing businesses that often experience some sort of stumbling block as they grow their organization. So we hear it all from, I need somebody to help with the accounting, to our sales are growing at an exponential rate, but cash flow isn't necessarily following. So we help the business owner know and understand the cash conversion cycle, and take a look at their balance sheet, income statement of cash flow, really focus on the basics and what it takes to meet all the demands of a growing business from an operational finance standpoint. My background has been that of a controller, CFO level for the last 18 years, and always looking for new businesses to assist in growing their business. Today, we're going to talk about the 5 parts to any finance transaction. So, any Finance 101 curriculum, you're going to find this as part of a finance class that one would take in an undergraduate study as they work towards a degree in finance. And just as we work with our clients, what we need to do first and foremost is, if we want to know where we're going, we need to know where we are today. So in finance, what we're talking about here when we're looking at the time value of money is 5 things. First of all, FV would stand for future value, and that's the numerical amount something will be at a point in the future. PV is present value. That's the numerical amount that something is now. Rate stands for interest rate. That's the rate at which something accumulates. And we're not going to talk about it today, but when we're talking in financial terms of a transaction that we know the amounts in the future, and we're bringing it back to today, the present time period, that's what's called a discount rate. So compound interest and discounted interest are polar opposites. NPER is the number of time periods in the transaction. So it's the number of time period over, for example, in which payments are going to occur during the term of the agreement or the contract. PMT is payments. It's the amount of each payment at each time period N, or NPER. Now, I've used FV, PV, rate, NPER, and PMT intentionally, because in today's business environment, you're going to use Excel, Microsoft Excel, and these abbreviations are going to come in handy once we start punching these numbers into Excel. The reason that one takes a class in finance or checks out a webinar like what we're talking about today with this particular topic is that it seems a lot like a puzzle, and I don't know where to begin. Now, the key to this is that when you're out in the business world or in your personal life making a business transaction, perhaps buying a car, leasing equipment, there's just an untold amount of ways that finance comes into our daily lives that runs under the radar. But the good news is, and the key here, is that with 4 of the items that we just talked about on the previous slide, with 4, we can always calculate the 5th. Now, the good news is Excel is going to assist you with figuring out these financial equations. So up in the function bar where you see f of x in green at the top of your screen, and if someone looks at this particular video at some point in the future, I reserve the right to say that Excel and Microsoft can always change things around a bit, but the functionality of what we're talking about hasn't changed in several upgrades of Microsoft. So if you type into the cell that you're starting with, here I'm in cell A1, and type in equals PV, where you can do a search by clicking on that f of x symbol for present value. A screen like this is going to open up for you, where we can enter the rate, the number of time periods, the payment, and the future value. The type is for a little bit of advanced finance, if you will, and assuming that all payments are made normally, just like any other transaction that you typically deal with, and there's no payments up front, these types of things, we can leave that blank. A more common use, instead of creating an entire amortization table of however many payments that you've made, which you could do in Excel with even limited skills, if you use the payment function, the first thing you're going to be asked for is the rate, the number of time periods, in other words, the number of payments. If it's a 5-year car loan, it would be, or whatever loan, it's the number of time periods is 60. If it's a 4-year loan with monthly payments, it's 48. If it's a 4-year loan with annual payments, then that is 4 payments. PV stands for present value, so if we're starting out with, for example, $10,000, then we would put in $10,000 in present value. And in the next cell, future value, if we're paying it down to 0, then that would be 0. We hit OK, and Excel will give us the resulting payment. Okay, so to revisit, as long as we know any of the 4 of these 5 variables, we can always solve for the 5th. So if we know what our future value is going to be, paying a loan down to 0, we know what the present value is, an interest rate, number of time periods that we're going to be making payments, you can calculate what that payment is going to be. If you want to back into your interest rate, all you need to know is what the future value is going to be. Are you paying it down to 0? What's the present value of a piece of equipment or property? Number of time periods over which you're going to be paying it, the amount of the payment, you can back into that. So thank you for watching, and just remember that finance doesn't have to be a maze. You can reach me at jason.selno@oakhillbp.com. My phone number is 262-299-5541, and our website is www.oakhillbp.com. Thanks for watching.